Welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day as always. We're going to be doing a end of the year video, sort of reflecting on the good, the bad, and the ugly of what happened this year and what are we looking at 2024. Probably also be going over some strategic shifts. What am I thinking about doing? What am I focusing on? And we're going to be going over portfolio performance. We'll also be going over some of the nuances or some of the topics we discussed in this year. So I have TLT up, not for any particular reason that we're going to be discussing in depth. TLT is just a tool for you to capture the move of the long-term bond. So you can see there it's the 20 plus year Treasury bond ETF. So interest rates coming down, you should do well with this one. But no particular reason is why it's up. Probably just sort of a homage to the content we used to make in 2022, referring to the liquidity crunch. You can also check out the videos, all hands on deck live stream that we did this year regarding the banking crisis that happened. We took good advantage of that, I believe. One of the banks that we chose out of that crisis was actually US Bancorp, which I consolidated the financial holdings into. Now, of course, let's talk about 2023. What happened in 2023? So 2023 was a really good year. I think when we look at the performance, which I'll showcase more towards the middle end of this video, we did really well. We did outperform the market. And it was a strong year off of the back of another strong year in 2022 where we actually achieved a positive performance. I'll be showcasing that as well as a reminder to people or folks who have just subscribed to us and haven't been privy to that information. As a reminder, this is, well, for all club members, you have seen these charts already because you guys get to see the full holdings from the brokerage, per the brokerage, and nothing less. Now, as far as the discussion on the various investments that we've made, in 2022 was the year of big tech. We acquired Netflix earlier part of 2022, and then later we acquired names such as Meta that I think this channel has become famous for. Salesforce was another one. We also made a big position or allocation in Amazon. That's more so early 2023 throughout 2023. At this point now, it's no longer a main focus for myself. There have been other focuses, such as focusing on REITs. So 2023, I maintain, is the year for REITs, or has been the year for REITs, and we've made a strong accumulation in that department. For those of you who've been following me since 2021, you might remember those videos in late 2020 discussing selling REITs and why we were selling REITs. Those videos are all still up. It's the video where I discuss the comparison between Realty Income and I forget the name of the other REIT, but it's a comparison between Realty Income and Seritage Growth Properties. That's the other one. Now, what do I believe is going to do well in 2024? All right, so I'm already well positioned for this. I've already done the strategic shift. I haven't made dedicated videos to it outside of the club. So the club members, they know the three-prong strategy that I've kind of been focusing on. You guys on the public YouTube know of one of them, which is REITs. That one is also kind of more or less played out in terms of focal point. The additional strategy that's the more important one has been semiconductors. So I've actually allocated a good amount of capital to semiconductors. And if you've been paying attention to the portfolio updates, you probably have picked up on that. But if you haven't, I'm just basically telling you straight up that, yes, we've been accumulating semiconductors. So both in the personal holdings and in the holding co, of which I've been the most aggressive in adding new capital into every month. Now, as far as the semiconductor play goes, I'm mainly adding to fabrication plays. And for the most part, I think I'm pretty much set. I'm for the most part, done in that department. Although I think there's still some room to add. Many of them have already rallied quite a bit. And I've also been focusing, and I think I've done very well in a reflection sense, at consolidating positions. Now, the other point, or let's actually discuss a bad thing, something I did bad. That would be Dollar General. So Dollar General was without a complete mistake. The execution was a mistake. The allocation sizing was a mistake. If you follow me on Twitter, which if you don't follow me on Twitter, follow me on Twitter. I actually tweeted out about this and discussing the mistake and reflecting on the mistake. So the allocation was inappropriate. I would say in my personal holdings, it was appropriate. but in the holding co, it was inappropriate. What I mean by that, the allocation was too strong, even for my own analysis. So I provided club members with the analysis and even argued the proper allocation size of a position in Dollar General. And in the holding co, they got to bear witness to it. I did not do that. More so accurately doing it in the personal holdings, but that's neither here or there. It's still a mistake at the end of the day, and we did lose. It's the largest monetary loss this year. Percentage-wise, also, I don't think it's the largest percentage loss because there were some immaterial companies I bet that were there that I can't remember off the top of my head that we probably lost a greater percentage in. But all in all, in the holding co, because of some of the trades we were able to make, we only made 1%, but in the personal holdings, it was a stronger monetary loss and an even stronger percentage loss of 20%. So it still was a mistake. But some of the other investments that did really well, we were able to capitalize, of course, on the banking crisis this year. I consolidated the positions into US Bank Corp, which now we're well in the green, and excluding dividends. If you include dividends, even better. We really capitalized on the office Armageddon. If you've been living under a rock, you might not know that office REITs have been trading off and selling at very discounted prices, and we're able to capitalize on that, such as Kilroy. Kilroy has been the champion of the portfolio. We were also able to double capitalize on that with a company such as Steelcase. I think that one did really well. So we did decently well in the ancillary position department, so the supporter positions. The portfolio underwent some interesting changes this year, particularly kind of rounding out some of the supporter positions that I deemed as distractions. Now, given that last year we had such a strong year, this year we continue to have a strong year. What I ended up doing, and you'll see this in the performance figures for the personal holdings, I actually have been raising cash, but not because I'm bearish on the market. It's just a change in decision of capital allocation. So to be blunt, I'm looking at real estate and just diversifying my wealth into some more single family homes in particular. And I'll be discussing that a little bit here in this video, potentially later. So let's get into the performance. So the first performance, or the first screenshots that I'll be showing, is the performance of the holding co. So the holding co is the portfolio that I share with the club members. It was designed to be a fresh start to my investing journey that could exist alongside Capital Mindset. So it didn't have any of the legacy positions, although I do share with members as well the personal holdings performance. The dollar figures of the personals is always kept secret, but the holding co is the one that they get to see. So if you actually take a look, and I'll go ahead and showcase the first chart here, this is the year-to-date. We're going to be a year-to-date bro here. And by the way, on the right-hand side for the personal holdings, I went ahead and compared it to the S&P 500, but mentally you can go back to this part of the video and kind of switch back and forth. This is just for the ease of use, so I don't have to put the NASDAQ and the S&P and have like duplicates of the same performance or the same type. So 66.16 is the cumulative time-weighted return on the year-to-date. And again, this is, I criticize year-to-date bros because, okay, show me 2022 in this recent bear market. I'll go ahead and showcase this is the chart. The next one is 2022. So this is the performance throughout 2022 for the holding co. So we did actually achieve a positive performance. Now, remember, the holding co is fully invested at all times. And so that's an important detail that I'm going to be discussing in just a second. But one of the things that did really well or pushed us really well was, of course, some of the positions that you guys are familiar with. I won't be going into too much detail as to what the positions are in the holding co, just because that's a privilege to the club members. But for the most part, you can kind of guess or gauge what some of them are, because I don't necessarily change a strategy all too much by any stretch. In fact, the only difference actually is more of not necessarily handicap, depending on how you look at it, but I only do long common. I don't do any option strategies or anything like that. I keep it rather simple. Now, just because I have this chart here and I already showed it to you, this is what the chart would look like, but it's not really too important. You might notice that, I guess, sometimes the rate of change in performance is a little bit different. So we were able to navigate October a little bit better than the QQQ. Now, for the personal holdings, as far as like the more material currently, because that is changing over time, but currently the more material portfolio is the personal holdings, which this includes, all of the non-holding co assets. And that actually performed at 30.65% on a year-to-date basis, beating the S&P, but underperforming the NASDAQ. Because if you go back and see what the NASDAQ performance was that I showcased in the other screenshot, you would notice that. So in this instance, the caveat here is, well, I'm holding actually more cash. Remember, the holding co is fully invested. So from a portfolio perspective, it being fully invested, it's basically the totality of just investing in common stocks. The personal holdings has fluctuated in cash allocation throughout the past several years. Right now, I'll tell you the figure, it is sitting at roughly 17%. Earlier this year it was higher, and then it got a little bit lower, but then higher again. And again, the reason or the rationale for that is to have capital available. It's not necessarily firepower. Technically, I can, but I don't want to designate it. It's not designated as firepower used towards stocks, but instead going to potentially be used for real estate, which I am more of a conservative real estate investor. I don't like to use too much leverage. I like to buy the property cash if I can. Although, and if I want to use leverage, I'll use it later in a cash out refinance, something like that. But, and if you guys are wondering, I actually should talk about this product because it's not very well advertised. I don't know why they don't. But Merrill does offer, and if you guys haven't noticed, this is all a Merrill brokerage account. But Merrill does offer a very good interest rate on your cash. You have to do some digging into the product, but I'll go ahead and help you out with this part. It is called the Preferred Deposit Program. The minimum requirement for opening or starting this program is $100,000, but the yield that you get on your cash, on your idle cash, when you deposit it, it's very liquid, by the way. I've tested it out. I use it myself for quite some time now, but you get roughly, I think it's 5.02%. You could get better elsewhere, but I prefer just having it all in my broker. You might prefer a money market account. You might even prefer some ETFs out there like GOVT. Sorry, not GOVT. The name escapes me, but there are some ETFs out there that capture the short-term treasury. So you'll be able to find that pretty quickly. Again, there's also money market accounts that should do more or less the same thing, or money market funds, more or less the same thing. So that's the story there. And just to remind everyone, I've shown this in the past. This was the 2022 performance for the personal holdings. So while the market went down negative 14.44%, we achieved a 25.02% throughout that time period. And then going over roughly the totality of it all, we did fairly well over the past several years. And so right now, and this is some of the jokes amongst the club members, that once Meta hits $400 a share, I will retire. And that is somewhat true. As soon as that were to occur, because of the amount of capital that we initially invested in Meta back when we did, and it's not just Meta, the joke is it's Meta, but we've done fairly well. I'm reaching that point where I'm going to be doing some sort of change in like, let's call it work approach, because of where the investments have really gone. So right now, strategic shift will actually be hunting down sort of capital preservation strategies in the form of real estate. And then at the same time, still trying to allocate the equity portion of my investments into what I believe is best positioned. So the cash pile is not necessarily available, or it can be available. It's really up to discretion. But right now, while it's sitting there collecting yield, I'm hunting for real estate deals. And I'll talk really quick about how I'm approaching real estate in 2024 and 2025 and beyond. I'm approaching real estate from the perspective of capital preservation. I look at real estate as sort of like a method or an asset that allows me to accumulate wealth and preserve it, not necessarily take that and like live off the rent. I don't think of it like that. I don't look at it as a wealth generator, although it can be used to generate wealth. I'm viewing it more so from an inflation-adjusted protection for my wealth. And so that being said, everyone is different in terms of how they approach real estate, how much leverage they want to use. Again, like I said, I'm a bit more on the conservative side when it comes to that. I believe less leverage is better. And at least at the end of the day, I can decide at what point I want to actually take out equity from the property at the leverage rate that I want. Not the interest rate, but the leverage rate. I want to keep 50% equity in the property, take 50% out, that sort of thing. So I think that 2024, we'll see how my allocation will do. I've also been allocating a good amount of small caps. That's been actually the theme. And I'll start by saying the amount of contributions. If you guys didn't know this, I think I've talked about it in live streams, but this is a dedicated video, so I want to make sure I say this in this video. I pretty much put no new capital into the personal holdings, and all the new capital goes into the holding co. And so if you're watching this and you're wondering, what's the allocation strategy for net new capital? Yes, the amount that you see go into the holding co, that's pretty much me going all in. And my goal in 2024 is to increase my income and then continue to actually increase my capable allocation to the holding co. And, from there, we'll see how things go. The other question that I often get, and it's actually true, I do think about doing this, and it's likely I end up doing this at some point. The personal holdings might end up just going straight into the index at one point. As I start to liquidate the positions, I might decide, hey, we did really well. We're not going to mess around. And now we're in a different phase. We're approaching the phase of capital preservation, where I still can look for opportunities that I think will do well above the market, but also trying to focus more so on, not forgetting rule number one. Rule number one being not losing any money. So that being said, I wouldn't be surprised if at some point in the near-term future, when I start to roll some positions off the portfolio, then something like a product like a VTI or a VU or even a VT, really just depend on what my particular goal is or how hands-on I want to be in terms of the allocation. And then maybe some mix. Maybe if I really want international exposure, I take VXUS, and then some combination of S&P 500 or VTI, or heck, even QQQ. Really, I'm not there yet as far as what I'll do. I've always been a allocator, but right now it's just changing a bit of the mentality. So really excited for 2024 because I do think my current allocations will do well. Now, I'm not sure it's going to be a year for big tech. That's a different discussion entirely. I think 2024, if we look at the likes of Meta, I might expect to see the $400 mark. We might see it, and then we get that proverbial or the metaphorical retirement for myself. But who knows really. With the small caps, I do think small caps are going to do really well in 2024. And I voted with my dollars. Small caps, and I won't really talk about the exact names because, again, that's more so something I discuss with the club members. It's been one of the focuses in terms of allocation. And I think that small caps have done really poorly in the past as a factor in the past couple of years. And I think they have a possibility of doing really well. Now, there's some discussion to be had about the disintegration of quality in the small cap sector. But for the most part, I think within the small cap sector, there's actually some really good value. Now, again, like I said, there are themes in every year. 2022, I voted with my money that big tech was the theme. And so I took really strong advantage. If you've been following the channel for a long time, you remember the old portfolio updates in early 2022. There wasn't that much big tech exposure. There was Google, but Netflix wasn't in there. And Amazon was remember we trimmed Amazon a lot. And so Amazon was a small position at that point. Then 2022 rolls off, and then boom, now we're in 2023. And the portfolio composition looks almost entirely different, right? We have no energy. We have, we didn't have Cardinal Health, like a lot of these other boring businesses. Unum Group. Right now, there is a new insurance company. There's not a portfolio update, but there is a new insurance company that has made it back onto the portfolio. Two new insurance companies. Sorry, there's two new insurance companies that are back on the portfolio. So things are changing. New opportunities have opened up. It's not just a buy big tech all the time. I think that's actually a mistake. But, all in all, I think, I'm pretty optimistic. You might look at me and say, it's kind of a bias due to the past performance, because of course past performance is not indicative of future performance, and I could do very poorly in 2024. I could do very poorly in 2025, and for here on out into the future. So who knows? But we will see. Other than that, I want to thank you guys so much for watching this video. And if you guys are curious about what the club looks like, how it is, you can check in the description down below. There should be a link for you if you want to check it out. I will be increasing the membership dues in 2024. I believe I'll do it at the end of January. So I'm going to be increasing it roughly to where you might see other clubs at. Because frankly, I think the value, and I'm biased by saying that, but I think the value that myself and the other contributors provide is worth it. But you guys can feel free to check that out. If you're not a subscriber, go ahead and feel free to subscribe. And if you liked the video, feel free to share a like. With that being said, thank you guys so much for watching, and I will see you guys on the next one. Bye.